Welcome to Compass and Clock. I'm your host, Mary Copeland. This infotainment podcast explores how to live your best life now and well into retirement. We'll discuss topics in financial planning, housing, and insurance. We'll talk wellness, relationships, and leisure activities. A full active life requires planning for your goals and preparing for the unexpected. I'll introduce you to a variety of guests, from knowledgeable experts to folks sharing stories of their life experiences and so much more. Because life is big. All is intended to help guide you in planning for what you need now and at any age. Like and subscribe so you don't miss a thing. Today, my guest is Ted Butler with Mutual of Omaha Mortgage. Ted is an industry expert in the area of the FHA home equity conversion mortgage, more commonly called the modern reverse mortgage. Bringing over 21 years of experience, Ted has been a manager, director, vice president, and originator with some of the top lenders in the nation. Ted, welcome to the show.
I am so happy to be here, Mary. A pleasure.
Well, I look forward to our conversation today, which is about reverse mortgages, and we will focus a bit on the purchase of a home with a reverse mortgage. So I'm going to just jump right in and start with the first question. Ted, what is a reverse mortgage?
Oh, that is a great question, Mary. When I talk with folks, I think one of the first things that I want them to understand is that it's two things at once. Yes, it's a mortgage. So it's just like any loan that they have where they use their home as collateral. Typically, you have a mortgage where you make a monthly payment to the bank. With a reverse mortgage, there is no monthly payment requirement. But it's also more than that because, number one, it's a program not created by the banks. It was created by the Department of Housing and Urban Development and has some very interesting superpowers that go along with it.
Okay. And Housing Urban Development, otherwise known as HUD, right?
Correct.
I'm sure people have heard HUD before. So can you tell us a little bit about the history of the reverse mortgage and how it became what it is today, the FHA home equity conversion mortgage, which is also known as HECM?
HECM, yeah, HECM, HECM. Well, it's kind of an interesting story. The first reverse mortgage done in the United States was way back in 1961 in a little town called Portland, Maine. This is all documented. And it was truly an act of kindness when one day one of the bank's clients had walked in tears because with the recent passing of her husband, she was no longer able to manage their somewhat modest monthly mortgage payment. And whether it was divine or just timing or however you want to look at it, it just so happened that her husband had been the local high school football coach. And it also just so happened that the manager of that thrift had played football for this woman's husband and took exception to her situation. And while the bank couldn't forgive her loan, they decided to create a special condition on her loan that allowed her to continue to live there without making any monthly payment. And the bank would just continue to charge interest, and that interest would be collected when she sold the house, when she eventually no longer lived there. First reverse mortgage done in America. Really a marvelous story. Fast forward a while, and banks left to their own devices are probably not looking out for people like this dear sweet lady. They're looking out more for themselves. And so, unfortunately, the reverse mortgage became much more heavily in favor of banks than for the consumer, so much so that the federal government stepped in and did away with what is called a reverse mortgage. But in its place, created something called the FHA Home Equity Conversion Mortgage Demonstration Act of 1987, which was a version of the reverse mortgage created with the consumer in mind and all of the protection oriented toward that senior homeowner. And it was so successful in its launch that the very next year, 1988, it was actually signed into law by then President Ronald Reagan. And so what we have today is more than just a mortgage. It is a program created by the Department of Housing and Urban Development, now called the FHA Home Equity Conversion Mortgage, or HECM.
I noticed you said the senior. So while you were giving us the definition and history. So with that said, who might qualify then for the HECM? It's not
Well,
just
it
for
is.
everybody.
No, it's not. I wish it was for everybody. In many countries, it's open to a much broader group of people. But here in the United States, for the FHA program, the minimum requirement of age is age 62 for at least one of the homeowners. Their spouse has to be at least 18. Um, and there's an age limit. You cannot be any older than age 150 to use the program.
Okay. Um, but when you qualify for this at age 62, there's more than just the age, right? Aren't there other qualifications like you need to live in the house for X amount of days? It has to be a primary residence or something, or am I mistaken?
No, it's more than just a mortgage and qualification as well. Yes, age is one of the qualifiers. It can only be used on your primary residence, meaning the house that your credit reports to, your driver's license, et cetera, et cetera. You can have more than one home, but it can only be done on the home that is your primary residence, where you live for the majority of the time. Um, HUD is going to look at three criteria to determine how much you qualify for with this program: age of the youngest title holder, the appraised value of the property, and then a third factor that HUD refers to as the expected interest rate. Those three numbers go into a special HUD calculation that determines how much of that home value this program will extend to the borrower.
Okay. So now, if somebody is considering this, is it smarter to pay off your mortgage today? Or should I rephrase that and ask you, do I have to pay off my mortgage today? What's the best thing to do?
Great question. Um, Paying off a mortgage, while it does one thing that leaves somebody without a monthly mortgage payment, you've just poured a ton of money into an investment that's illiquid. Great, you don't have a monthly mortgage payment, you've paid off your mortgage, but what you really need in retirement more than anything else is liquidity and income. Um, the majority of people that we work with today have a mortgage on their home. When I started 20 plus years ago, it was very common for us to work with folks who had thought that conventional wisdom led them to pay off their mortgage. Financial planning will tell you no, that is not a smart choice. What you should be doing is applying every penny that you can to what you really need in income in retirement, and that's income. So rushing to pay off your mortgage, no advantage, especially using the modern reverse mortgage. Let the reverse mortgage pay off your mortgage for you, allow you to keep more of your very precious liquid assets to use for what you need to, that's living at this point in your life.
Hmm. I always wanted to know the answer to that question, so thank you.
I bet other people do as well.
Exactly. I believe there are three ways to access funds from the HECM on an existing home. Can you
Mhm.
tell us a little bit about that, please?
You bet. So once that number has been established, how much the HECM loan is going to provide for the borrower, and we've paid off any existing mortgage or liens on the property, any additional funds available are going to be provided in a choice of three different ways. Instead of making a monthly payment, you can have the reverse mortgage provide a payment to you every month. If increasing your monthly cash flow beyond just paying off a mortgage and saving that money each month is important. Or if you need access to funds immediately, you can take cash out in a lump sum. Or one of the most popular ways to use this program is, let's say you don't need to take anything out at close, or maybe just a small amount. You can use what's called the home equity conversion mortgage line of credit, where you leave those funds that you qualify for inside the reverse mortgage and draw from that as you need them. And the amazing thing is that HUD actually assigns a rate of growth to those unused funds that are in your reverse mortgage line of credit. A very, very powerful tool. Or you can use a combination of any of those. And once you get into your reverse mortgage with your payment plan, if you find that you need to adjust it or change it, HUD allows you to change your payment plan at any point as well.
I just want to clarify one thing. With the reverse mortgage and or HECM, with the opportunity to not pay a monthly mortgage payment, I believe that there is a payment though that you do make each month, and that's homeowners insurance, um, and something else possibly. I just want to make sure.
Property taxes.
What, okay,
Yep. Yeah, really, really good point. Just like any homeowner with this program, you retain title to your property and you retain all rights and responsibilities of home ownership. Just as if you had paid off your mortgage, you're still going to be responsible to pay your property taxes and your homeowner's insurance. Just because you have the home equity conversion mortgage doesn't mean that you're absolved of those responsibilities of home ownership. But you also have rights of home ownership, meaning you can sell the house at any point. You can pay the loan off in part or in full. There's never a prepayment penalty. And if you should be in this program when you pass away, the house will go to your heirs or the estate, however you have determined that asset to transfer.
perfect. Thank you for clarifying that.
Great,
So,
great questions.
thank you, Ted. I appreciate that. I put some thought into this, you can tell.
Mhm.
So, you mentioned during our conversation that someone can use the HECM to purchase a home. So why would someone use the program though to purchase a home? What are the advantages there?
Well, it's interesting. Many people, when they get to this point in their lives, retirement or pre-retirement, are looking to probably move out of the house that they raised their family in. They probably don't need 3 or 4 bedrooms, and they probably don't need a house that has multiple staircases or a large yard. And so many people are going to look to find a more appropriate home at this point in their lives. And what sometimes people think about doing is selling their house, and they probably realized a tremendous amount of gain in value of that property over time. And so they would naturally be inclined to pay cash. Why do they want to pay cash? Well, the last thing they want in retirement is to have a monthly mortgage payment. That's the most compelling reason to pay cash. But there will be other people who maybe still have a mortgage on their home when they go to sell it, and they're not going to be able to pay cash for their next house. So they're going to have to finance that purchase. What Mutual of Omaha calls the lifestyle home loan, or the HECM for purchase, allows a home buyer the opportunity to use the best attribute of a cash purchase, which is no monthly mortgage payment, and combine that with the best attribute of a conventional purchase, which means you don't have to put all of your money into the purchase of the house and still not have a monthly mortgage payment. So for many people who would normally pay cash, let's say, you have enough to buy a $500,000 house for cash. Well, wouldn't it be nicer to maybe buy that house for $300,000 and be able to put an extra $200,000 in your retirement savings, and still not have a monthly mortgage payment? Or also very common is somebody, let's say, does walk away with $500,000, and depending on where they're living, $500,000 might not buy them anything close to what they might like, and they can turn that $500,000 into, let's say, an $800,000 new home purchase, again, not having a monthly mortgage payment. Two distinct advantages on why this program would be appealing.
Very appealing. So tell me then, how does that differ, purchasing a home with a HECM versus purchasing a home with a conventional mortgage?
Well, a couple of things. Number one, the obvious, our mortgage does not require a monthly repayment. So right away, there's a huge cash flow advantage there. And then the other is that because HUD is conservative, there will be a larger down payment required, probably using the HECM for purchase than with a conventional mortgage. But again, most people who are using this program are at a point in life where they are going to be realizing a significant amount of proceeds from the sale of that existing home. So the higher down payment is usually something that they can easily accommodate.
Okay, so that's why it's best not to use all your cash to buy a home then, if I'm understanding correctly.
Without a doubt, from a financial planning perspective, paying cash for a house is the most expensive way to buy a house, period. You are going to spend the most amount of money possible to purchase an investment that, yes, it's going to grow in value over time. But if you use the HECM per purchase, you can purchase that same investment, get the same return on it for only a fraction of that cost. And compared to conventional, nobody really needs or wants a mortgage payment in retirement. For many, it's their largest single monthly expense. And believe me, your savings and your lifestyle will benefit not having to make or worry about making that monthly payment.
So what happens at the end of a HECM? And, meaning, explain to us, going over how a homeowner selling the home, versus, for instance, the scenario with heirs in the situation, because there's two ways, somebody either sold it themselves or they passed away and it's their estate. Can you give examples of both of those? And we have time for you to go into detail here.
You bet. And that's a great question. That's probably one of the greatest concerns when we talk to people about this program is what happens at the end. One of the most common myths or misconceptions about reverse mortgage is, the thought that somehow the bank or the government would end up with the house. Don't know where they got that from. Maybe from reverse mortgages prior to 1987. Had nothing to do with the government back then. But the way things typically happen with somebody who's in a reverse mortgage today is they will probably end up selling the house at some point. Statistics tell us that 80% of us are not going to be living in our own home when we pass away. We will probably be in a facility of some sort. This program allows that homeowner to continue to live where most want to be, and that's in their own home for a much longer period of time. But inevitably, something may happen either physically or cognitively where that homeowner no longer is going to be able to live in that house. So in that case, they would go ahead and list the home for sale. They would pay off the outstanding balance that's owed out of the proceeds of the sale, and then they would keep the remaining proceeds. Many times they would use those proceeds to help pay for their cost of care. Let's say if they go to assisted living or something. Now, there will be a percentage of people, though, that are going to be in their reverse mortgage in their home when they pass away. And here's where some of the differences between a regular mortgage and the FHA home equity conversion mortgage can really be illustrated. With a regular mortgage, if you pass away, your heirs are going to be given 90 days to repay the loan before the bank begins foreclosure proceedings. The bank doesn't care that somebody passed away. All they know is that the lien holder or the borrower has passed and they want their money. But HUD realized that for a large portion of our borrowers, because we are serving people in the last chapter of their life, they are going to be passing away with this program in place. So HUD is going to give the heirs 6 months without any pressure to determine what they want to do with the property. And if they cannot take care of the house in 6 months, HUD is going to be able to provide them up to 2 3-month extensions in order to handle that part of the estate. Why is this important? Well, if you've gone through this, and many of us at our age have had to go through this with parents or loved ones, number one, there's probably a grieving period that you'd like to get through before you have to make major decisions. That's really nice to know that there's no immediate pressure. It may take time for people to determine exactly what they want to do with mom or dad's house. Do they want to keep it? Well, great. If they do, they'll find some way to pay off what's owed. More than likely, though, the heirs are going to list the property for sale, pay it off, and then the heirs keep the remaining equity. But it's just a glimpse into some of the care that HUD has put into creating this program. There is no other mortgage that allows that estate that grace period. And then there's one other factor where HUD's care and concern comes into play, and this is an FHA mortgage, and it carries a very special type of FHA mortgage insurance. One of its features means that this loan is non-recourse. And that means the home will always stand for the debt. Now, many of us remember what happened a few years ago when we had that dramatic crash in the housing market, and then another one 20 years before that. Home values don't always go up. Sometimes they go down, and sometimes they can go down precipitously. If somebody in a reverse mortgage ever finds themselves, or the estate finds themselves in a situation where home values have dropped below what is owed on the loan, the mortgage insurance that comes with this loan will cover that shortfall. It not only covers the shortfall for the bank, but more importantly, it covers the shortfall for the homeowner or the homeowner's heirs. Yes, sadly, the real estate market may have collapsed. You may be in a situation where your mortgage balance is greater than what the house value is, but you're not going to pass a debt on to your heirs, or you're not going to be responsible personally for that shortfall, as you would be if you had a conventional mortgage on your house. So, HUD has really thought this through, and they've realized that the end with this program is every bit as important as the beginning. And it gives people such great assurance knowing that they're not going to pass a debt onto their kids. Yeah, it's really a really well thought out program.
I'm glad you brought up the last part because I was going to ask you if it's underwater, so to speak. So I'm glad you illustrated that. Um, when somebody is considering doing a reverse mortgage, one of the things that you were talking about was how they could do the home equity line of credit or etc. Can you just give a little example? Because we just have an extra couple of minutes here. I'm picturing somebody's aging in place in their house
Mhm.
and they're getting up in years. It's a husband and wife, and they usually take care of each other, right? But they could use a little assistance. So I believe one of the beauties of the HECM is the ability to tap into some of that equity to pay for like in-home care, to have somebody help. So can you talk a little bit about how it helps with long-term care costs while you're living in the
And
house?
that and that's a great point as well. The most common use of funds from the reverse mortgage, quite interestingly, is home improvement. Many times those improvements are features within the house that provide safer aging, whether it's getting rid of carpeting and putting in flooring, bringing in handrails, redesigning a kitchen so it's more wheelchair accessible, all sorts of marvelous uses. But also we know that care has a cost. And many folks today do not have long-term care insurance. And so they'll utilize this feature that you're talking about, the line of credit from the home equity conversion mortgage, to provide the ongoing funds needed to bring care into the house. And people use it as an alternative to long-term care insurance. Um, I have, sadly, a growing number of people that I work with that are now dealing with memory care issues, dementia, Alzheimer's. And we're finding those to be some of the most difficult situations to try and take care of at home. Now, the remaining spouse, the spouse that's not affected, ends up being the primary caregiver. And it can have a terrible effect on that individual, not only physically, but emotionally, because those individuals with dementia and Alzheimer's can be very challenging to take care of. So we have a number of folks that will use this program to provide the cost of care for that spouse, putting them in a memory care facility that does two things. Number one, it makes sure that that spouse is in a safe situation, reduces flight risk, make sure that they're getting their meals and their medication on time, but it also has an equally profound impact on that spouse who's left at home, relieving them of a huge amount of pressure and burden. And they just realize that their house is an investment that they can use to do all sorts of things with, but especially to help take care of the cost of care for somebody either with a physical situation or a cognitive situation. Really glad you asked that question, Mary.
And the
It can be
well
a
spouse,
marvelous solution.
yeah, and the well spouse also has the peace of mind that they have a roof over their head. And, Sometimes, the two spouses do need to live in two different places. We have
Yeah.
just a minute here to
Mhm.
squeeze in one more question. And what I'd like to ask is, what's the timeline from somebody having a conversation with you, that they want to go down this road? How long does it take to qualify for this and close on a house if they find a house right away?
Okay, so if somebody's looking to purchase a house, most importantly is that we work with them on pre-approval.
Mhm.
Pre-approval will take 24 to 48 hours. We use a fully underwritten pre-approval, but you do not want to go house shopping unless you know how you're going to pay for it. So talk to us first. Pre-approval will take 1 to 2 days. Then you'll be equipped with something that you can use if you want to make an offer. On a purchase, we're going to require a 30-day close, very standard in the industry. And your seller is going to be thrilled when they see the sizable down payment that you're going to be submitting with your offer. If it's somebody that's in an existing home and you're looking at utilizing this to stay in place, then we typically close our loans right about 30 days. Um, we are not only the largest reverse mortgage lender in the country, but we are the most highly rated. And that has a lot to do with our outstanding service. We have the best processing and the best underwriting. So, start to finish, I would say 30 days is a realistic timeline. But we have done loans in 21 days, 14 days, 11 days. But realistically, let's think 30 days to be comfortable.
Great. So there's this amazing program and it isn't stretched out and takes months. It's a nice turnaround.
Not
So,
if it's done properly. It shouldn't take that long. We hear plenty of stories from other people working with other companies where it's taken
oh,
3, 6, 9 months. But you know,
so it's
quality of service is important.
so it sounds like the best advice is make sure you're working with a reverse mortgage specialist that really knows what they're doing and with a reputable firm. So.
Absolutely. Yep.
Well, Ted, I think the information you have shared with us today is truly invaluable. And I appreciate you taking the time to explain to myself and our audience how a modern reverse mortgage really works, also known as a HECM, and all of its incredible benefits. But we are out of time. So thank you again for being with me today, and to our listeners. Thanks for joining Ted and I today, and we'll see you next week. Take care.
Thank you so much. Thank you so much, Mary. I've appreciated the opportunity.
Yeah, it's been great. I enjoyed our talk, and it really is helpful. This is such an important topic right now that I want people to understand how it works. So thank you again, Ted. Bye-bye, everyone.